Hi, good afternoon, everybody. Hello, and welcome to the breakout session after lunch. I hope you all had a good cup of coffee and a good lunch. The last few speakers over lunch were really inspirational, so I hope you're excited to hear more from some practitioners from financial institutions on how to really address the problem of climate change. So welcome to the breakout session titled The Race to Reach the Clean Trillion, a Focus on Emerging Economies. My name is Stacy Swann. I'm with Climate Finance Advisors, and I'll provide a few short opening remarks, but my role here today really is to moderate the discussion among our panelists. And we hope to have a really interesting and insightful discussion of folks who are on the front lines of trying to accelerate and catalyze and scale up financing to address these things. A little housekeeping. The session will run about an hour. We're starting it's right now just about 1:45. We'll end at 2:45. We'll hear from each of our panelists. They will introduce themselves and then speak a little bit about their perspectives on scaling up financing and addressing these challenges in emerging markets. And towards the end, we'll open up the floor to Q&A. So please have your questions at the ready. Start to think about what you might ask each of our panelists in terms of responding to some things that they're saying, or really the big challenge of scaling from billions to trillions in emerging markets. So just to open up, I really wanted to emphasize or call out from the title of this session the two important themes that this session brings together. Obviously, the race to reach the clean trillion. We've heard a lot today about how we don't have time. Time is actually is of the essence, and we haven't achieved the kinds of investment levels that we need, and now we have less time than we had yesterday, and tomorrow we will have less time than we had today, but in an exponential way. And then a focus on emerging markets. So last night I was at dinner with some colleagues, and we talked about the billions to trillions phrase, and we talked about the fact that this has been something that people have been talking about for about 5 years. And before that, people talked about scaling up financing. But why? Really, it's because we know we need that tackling climate change requires shifting investment flows away from high carbon fossil fuels into low carbon clean energy sources. And financial institutions play a really critical role in that effort. This won't happen without leadership from the financial sector, from all parts of the financial ecosystem, from major institutional investors to banks to private equity and everyone in between. The Ceres Clean Trillion campaign was launched in 2004 at this summit, and at that time Ceres identified the need for roughly an additional $1 trillion in additional annual clean energy investments to stay below 2 degrees. Subsequently, that number was updated, and it was the series showed that the need was 1.2 trillion, and the increase was really due to the failure to ramp up investments in the time frame between the first assessment and the second. Last year, in 2017, Ceres estimated the need is now 5.3 trillion. In additional investment through 2040 in the electric power sector alone to meet the 2-degree scenario. So this is significant. The numbers are increasing with each day. And notwithstanding the gains that we are making, that we've heard a lot about today, and the leadership that is happening within industry and the financial community, the investment levels remain far short. We're tracking at about 1/3 of the investment needed to stay below 2 degrees and to limit the worst impacts of climate change. And while we didn't focus on this 5-10 years ago as much, but as our keynote speaker over lunch emphasized, we now know that not only do we need to accelerate investments in clean energy, but we've already locked in enough warming that we also need to focus on building in resilience across all of our sectors, across the built environment, and of course throughout the way we finance. So today, we have to actually do two simultaneous things. We need to scale up our investments and accelerate our investments in clean energy, and we need to squarely address climate risk across all sectors to build in resilience to what we know will be a warmer planet. And these things have to happen all at once, simultaneously. For me, that implies that financial institutions have to do far more than simply establish a renewable book or an energy efficiency lending platform, or invest kind of with others to put together new products or financial mechanisms. But financial institutions and investors also need to scale up and integrate how they address climate risk in their investments and in their operations. And this is not just in energy, this is across all sectors, and we've heard this echoed in a number of the speakers that have presented earlier today. Really, climate change needs to be mainstreamed across all types of financing. And this, of course, can be challenging for a host of reasons, both technical and cultural. We heard today a lot of our speakers and panelists talk about leadership and the need for leadership within the financial sector and within corporations, and that leadership really matters in terms of accelerating some of these actions. And the corporate culture and corporate behavioral change that's needed is not insignificant. So in terms of scale and emerging markets, this is now a conversation beyond energy. This is a conversation in clean energy, in infrastructure, and in resilience across all sectors. But the good news is there's a lot of opportunity. In addition to the estimated $5.3 trillion in clean energy investments, the infrastructure sector alone presents a significant amount of investment opportunity. In the US, new energy investments and new infrastructure investments are approximately $4.5 trillion over the next 10 years to address simply the failed infrastructure alone, let alone the new infrastructure needs. And the Brookings Institute noted that globally, more infrastructure investment will be made in the next 15 years than the entire stock of infrastructure that currently exists. And they estimate that to be between 80 and 90 trillion by 2030. And in the same report, they also noted that emissions from infrastructure alone account for about 60% or more of total emissions, depending on where you are. So that's actually a significant amount of opportunity to both address emissions and address resilient investment. But there's a lot of work to do. There's a lot of potential investment opportunity and a significant amount of opportunity to invest sustainably. And the good news is, as we've also heard today, clean energy is now no longer alternative. It is mainstream. Clean energy investment opportunities are proliferating amid now inevitable and irreversible trend transition to a clean energy economy. Solar and wind are now cost competitive and in many cases far cheaper than fossil-based energy production. And if you were following the headlines this week, the Nextera CEO Jim Robo announced when he told investors on a Q4 earnings call that he predicts by 2020 it will be cheaper to build renewables than continuing to run existing coal plants. That's pretty significant. Emerging markets are a key part of this equation, and they're a key part of the equation to stay on track to 2 degrees. So we're here today to talk about the how to do this. We know that investors and financiers come in all shapes and sizes, but there are 2 really fundamental characteristics that all of them have. They're all looking for good investment opportunities, all of them. And they all manage risks. Every financial institution is making their investment decisions around a concept of risk-adjusted returns. This means that financial institutions are themselves risk managers. So the idea of climate risk is something that they can very easily start to integrate and wrap their hands around, although it's not that easy to do that in some cases, but they're starting. So how do we get to scale of financing, and in particular scale in emerging markets? How do we bring, for example, large institutional investors on the one hand, who are often cited as having a volume of financing that's needed to address this issue, but are fairly conservative in their risk appetites, together with financing that's needed on the ground to get those investments done, in markets where perceived risks may be higher than other markets? How do we bring together all the financing components in between in the financial ecosystem? How do you build an ecosystem for scale or enhance the current one, and in particular ensure the financing can get to the markets and the projects where it's needed? What are the component parts that address each type of financier's needs to balance risk and opportunity? And are there parts of that ecosystem that are missing, not playing a role or not playing a role and function that they should? Where are those gaps and where do we need to fill them? So this is actually somewhat what we're going to talk about today with our panelists, and we are going to talk about their role in scaling up investment in emerging markets through their perspective and the things that they do, how they address risk, or maybe blend finance or blend risks, how they ensure the component parts work together. Of course, Ceres is doing a lot to help bring those investors together. It's working through the Ceres Investor Network of 140 asset owners and managers, and through the Global Investor Coalition with sister networks, the IIGCC, the IGCC, the AIGCC, to mobilize the additional energy investment needed to meet these targets. So we're here to talk about all of these things, but in very tangible and practical ways. And we're hoping to learn from our panelists about the drivers for them of scale, and in particular what they're doing to accelerate their investments and investing in emerging markets. And we're hoping to unlock a bit of their views on some critical components to scale across the ecosystem. We've heard today the need for public policy to be complementary with investment vision. We've heard about blending finance and risk allocation. And that's not just about blending different sources of capital, but also critically about blending and sharing risks. So taking that financial ecosystem and putting the connective tissue between players in the ecosystem so that we can scale and catalyze some of these investments. And we'll hear about specific examples on how these institutions have worked across the financial ecosystem, within financial markets, with developers alike, to finance climate-smart investments. So without further delay, let's get started. And I will introduce our panelists. It's my privilege and honor to be moderating this discussion. We have Christopher Flensborg, who is the head of Climate and Sustainable Financial Solutions at SEB. Christopher joined SEB in 2003 and is the head of the Climate and Sustainable Financial Solutions Group, and is a pioneer in the green bond space. SEB worked closely with the World Bank, and he has developed concepts and mechanisms that enable mainstream investors to address climate investment in their portfolios. Really important way to bring in mainstream investors into this asset class and these types of investments. We also have Jeff McDermott, who's the managing partner of Greentech Capital Advisors. Jeff is a global specialist, works at Greentech as a global specialist advisory and investment management firm focused on sustainable technologies and infrastructure. And Jeff will talk a little bit about what they're doing both on developed markets and in emerging markets, combining a rigorous bottom-up financial analysis and integrating sustainability throughout what they're doing. And we have Maria Tapia, who's from the Inter-American Development Bank. She's an expert in debt capital markets and climate finance. She's a lead climate change specialist in the Climate Change Division and champions all efforts to bridge private sector capital to sustainable infrastructure projects and programs. So without further ado, we'll start, and I'll ask Chris to give a few opening remarks.
To the audience up there, please come down and sit down here. There's plenty of space. And thank you very much. So basically, just to give a short introduction to who we are and what we do. So I head this small unit inside SEB, which is called Climate Financial Solutions, or Climate and Sustainable Financial Solutions, which is 9 persons, and we primarily do green bonds. So we have basically 9 persons working on green bonds in SEB. In that unit, we have basically advised issuers which represent more than 20% of the global market on their frameworks. There will be issuers like the World Bank, like Ontario, like Quebec. It would be like KfW of Germany and many, many others. Alongside that, we have also been advising a number of developing markets. So we have a PPP, a private-public partnership with the German aid institution GIZ, where we are engaging in China, India, Brazil, and Mexico in basically capacity building, technical assistance, and interacting with them, meaning that we have been quite active in emerging markets. Alongside that, we have also inside SEB a fairly large asset manager. So our asset manager is managing one of the biggest microfinance funds in the world. So we are managing roughly 800 million in microfinance assets. And one of the things we're working on right now, that is basically to find out how we're going to bring green bonds and microfinance into the next chapter. How we're going to use the experience we have gained from the more than 70 sessions we have had in emerging markets together with GIZ to create bridges between your portfolios in developed markets and the projects that's appearing in developing markets. coming back to what you talked about, we realized that one of the biggest challenges is communication. It's perceptions, and that means that there's a lot of need for education both ways. What are the challenges? What is the development? I mean, asking China to close down power to go full renewables might not be feasible. That would mean that they will basically get a lot of social problems. They are in an expansion phase. They don't have the infrastructure we have in Europe and US. They need to build that infrastructure. They are building a lot of new energy, but alongside that, they also need the energy they already have, meaning they will continue to have coal, unfortunately, for a while, meaning that when they're doing green, they need to work both on green coal and green renewables. Whatever they call it green is, of course, a different matter. And unless we appreciate that and understand that, it's going to create friction in the dialogue. We don't have to call it green, we don't have to finance it, but it will be there. Alongside that, we have also realized that actually these challenges of communication might be the biggest opportunity I have ever seen in my time in investment banking. So I've been in investment banking for 30 years, and what we're seeing is that there's a need, as you mentioned, to basically rebuild our whole infrastructure. In Europe and the US, we have old infrastructures, and many developing markets, you need to build infrastructures, whatever that being grid or pipes and water infrastructure, or whatever that being housing and educational systems. And that investment is a great opportunity. And what we have been doing over the last 18 months, that is that we've been taking the experience we have from microfinance and being taking the experience we have from green bonds and are trying to bridge those to develop new models. So what we have learned and what we have seen that is that the green bonds is a fantastic instrument to source capital and put a label on the capital, meaning that you can basically determine what you want to do with the money, whatever that being renewables or whatever that being green housing, or maybe other society or SDG labels like social housing or education. So on the one side, we have green bonds where we can label the money and source the money. On the other side, we have microfinance where we basically have a model for sourcing projects and putting due diligence on projects. And we have realized that if we can merge those technologies, the sourcing and the auditing of projects in emerging markets, which is the way of sourcing capital and labeling the capital in developed markets, then we can also create a model for actually providing finance for projects alongside prudent due diligence. And I'll come a little bit back to that later, but that is very much what we do in my group.
That's great. Thanks, Christopher. Maybe I'll next go to Maria, continuing the green bonds discussion. Can you discuss IDB's work on green bond securitization pilot projects over the past several years? What have been the key successes and lessons learned from that, and maybe how does that help meet this kind of connective tissue challenge?
Thank you. Well, basically the IDB came a little bit late compared to other multilateral agencies in issuing green bonds. So at some point, we decided that issuing ourselves, our bank, becoming a green bond issuer, we will not add value to the markets that we serve. So instead, we start working on how to help issuers tackle the capital markets through green bonds. So we started our work piloting. First of all, we started piloting this securitization platform, but basically we did an analysis, a deep analysis on how renewable energies were financed in the region and what are the barriers for certain energy efficiency and renewable energy projects to get long-term financing. And we come to the conclusion that for certain developed markets in the region, when I say developed markets, I'm talking about Brazil, Mexico, Colombia, Chile, the barrier for financing renewable energy at the utility scale was actually not a barrier. They had different difficulties to get the financing, but it was not necessarily difficult to close that that financing gap. But for small-scale renewable energy projects and for energy efficiency projects, it was an issue. And we decided to start piloting this aggregation platform for energy efficiency, because imagine a 2 to 5 megawatt energy efficiency project, and I'm talking about in millions, a $5 million between $3 to $5 million project. Obviously, that size of a project, financial institutions, banks, they will try to open or offer financing that are not suitable enough in terms of term. These projects are mini project finance, so they require longer term. So we decided that if we put them together, and this is how we came up with this aggregation platform pilot project. We put them together and we try to homologize certain terms between the projects, certain standardization at the contract level. We could put them together and then tap the capital markets to get institutional investors, and with different blended financing and risk mitigation mechanisms, we can actually issue a bond with the risk profile that institutional investors will be able to take. But we really need to create a critical mass of projects to make them attractive for institutional investors. So we started with these aggregation platforms for small-scale projects, and we have already done 3 in Mexico for 2 for energy efficiency and 1 for solar distributed generation. And we did one we approved another one in Colombia. This year we're working now in the islands, in Jamaica and Dominican Republic, to try to keep replicating this type of financing solution. But that's part of the things that we are trying to do. The other things is we are still creating new type of products. For example, at a utility scale, instead of syndicating our typical loan to a renewable energy project, we are syndicated through a bond. And basically, we are issuing, well, we are not issuing, but we are syndicating part of our loan through a bond. And it always will go with our umbrella of multilateral preferred creditor that we typically use to protect the investor. And again, we are trying to look forward different mechanisms, mobilizing green funds, and mix them together to create products and that will be of an interest of an institutional investor or a regular investor. But we are working that on the private sector side of the bank. On the public sector side of the bank, we are working on enabling the environment. So we are doing these roundtables across the region in Argentina, in Mexico, Brazil, Colombia, and talking with, creating these roundtables between investment bankers, investors, issuers, and regulators, stock exchanges. So we're mixing a public-private dialogue to help enable the market. So far, Brazil and Mexico have already set up their framework on green bonds. And again, green bonds is something that it's now very popular in Latin America. And we just received a call from the stock exchange of Quito because they wanted to do green bonds. So again, at the beginning, we were, in a way, opportunistic, creating these vehicles to put together small-scale projects to issue green bonds or to help new issuers with risk mitigator guarantees to tap the markets. And now we are working with the stock exchanges, creating a network between stock exchanges so we can help them create the environment. So in a nutshell, we are working on both sides, not only helping create more issuers, but also enabling the environment so it will become easier to issue. It is difficult to become an issuer in the local markets in the region, so it's more difficult than to label it as green. So we need to help them establish the rules, the frameworks, the mechanics, and help them with the dialogue so it becomes easier for them.
Great, thank you, Maria. Maybe I'll turn now to Jeff. Greentech Capital recently launched an Emerging Market Sustainable Growth Fund. So wondering if you could tell us a little bit about that, but what informed the fund launch, and how are you investing towards the Clean Trillion through this fund and in targeted geographies?
Sure, but I first have to say, Maria and Christopher, there's a place for you in heaven. I mean, honestly, the fact you're one of the fathers of the green bond. I mean, was there 250 billion of green bonds issued? 370 billion of green bonds issued in 2017, and
115, 17.
115.
Altogether, 370.
Okay, 115 and 17, just to the record, get the number right, and 370 overall. But also in what you're doing, Maria, in terms of bringing that technology to South America and really getting it going, and also creating facilitating new structures around small-scale energy efficiency and renewables is phenomenal. Look, I think we're in the right place. Everybody here is in the right room because 80% of the world's population and 90% of those less than 30 live in emerging markets. We're going to build more infrastructure in the next 50 years in the emerging markets than in the developed markets by a huge factor. And frankly, we have to build this infrastructure with 21st century technology, because the planet will not survive if we build this infrastructure with 20th century technology. We have just to set the stage of our focus and my comments, we're equity investors in public markets. And kind of what our theory is that one of the things that can happen now quickly is public companies, if they all do everything they can to be more sustainable in their sourcing, in their energy, in their building factories, will make a profound difference in climate change. According to Climate Works, it'll take us halfway there and rid us of 10 billion tons of carbon by 2030 if companies do all they can that's available today to be more sustainable. So our view is that what we're focused on is getting public companies, because in these emerging markets, if public companies have a demand for clean energy, for water recycling, kind of a clean sourcing of raw materials, waste recycling, et cetera, that will create the end market, and there'll be the customer pull-through to enable these technologies to propagate. And I'll just tell you one quick thing that Stacy and I were talking about earlier. We really believe that what investors must know, and I've spent my life in boardrooms and talking to companies, is they are not really serious about sustainability. And the reason why they're not is because they feel like they can confuse people because there are not a standard set of metrics or reporting criteria around sustainability. And therefore, they like that, and they like saying, well, we're paying attention to the UN SDGs or the PRI or the Task Force for Climate Disclosure, and who knows what scenario analysis is. We're going to study that for 3 to 5 years. I'm in the room with these people. They're happy with that. And as you know, 60% of the chief sustainability officers report to investor relations. They don't report to finance. There's nobody at the board level in finance and risk is sitting there saying, what are we doing on sustainability? And the reason why is because investors are not being demanding enough. It's to your phrase, Christopher, it's a communication issue. And so our very simple point is that, ESG on most asset managers, what they're doing is they're subscribing to Sustainalytics or MSCI or somebody else who is taking, frankly, garbage information because the companies aren't giving good information, and they're kind of slapping different ratings on it. And it's not really very useful, it's not opaque, and it's not influencing corporate behavior. And so if we want to make a difference in climate change, we have to influence corporate behavior, because as I said, they can take us halfway there towards taking the carbon, decreasing the path of carbon emissions that we need to into the 2 degree scenario. And to influence corporate behavior, you have to basically say, I want clear metrics, and I'm going to hold you account, and I want to be able to compare you versus your competitor. If you could take the sustainability reports of Procter & Gamble and Unilever and look at their CO2 emissions per dollar of sale, and look at their water usage, and look at their waste recycling, and look at their packaging per dollar of sales, and if you could kind of take other metrics, which frankly, here's the good news. Great news is it exists. SASB and the Climate Disclosure Standards Board together have harmonized a set of standards which exists, which actually the Task Force for Climate Disclosure, which has the scenario analysis criteria, is basically endorsed. So the three of these organizations, it exists, frankly, right as of the end of last year. So this is the first year where it exists. And just the point we'd make is that by investors holding companies accountable to disclose this information, having been in I'm just saying companies will start behaving, and they'll start being more sustainable, and they'll create pull-through in emerging markets for better business practices around sustainability. So what do we do? In the absence of this, we have a concentrated portfolio of 20 stocks in emerging markets that are really heavily focused on ESG, and we have two experienced managers who've been doing this for a while, who basically go interview the companies and hold them to task for basically being sustainable. And in emerging markets, by the way, the governance aspects are really, really important, much more than developed markets, given there's a lot of these countries have weak governmental institutions, and the societal, social issues are also important. I'd say the thing that we've noted is that, if you allocate capital, if more managers did this and allocated capital to those companies, bought the stocks of those companies that were doing the right behavior, their stock prices would appreciate, they'd have a lower cost of equity, they could deploy capital and grow more efficiently, they would outcompete their competitors, and a virtuous cycle would prevail. And the second point I'd make just on this is that the reality is of the number of emerging market companies that are really focused on sustainability, it's a narrow list. I mean, we're talking about, Pakistan, Indonesia, et cetera. I mean, there's just there's not the companies like there are in the West that are really focused on environmental issues fundamentally. And therefore, what the point I'd make, though, is in all these countries, though, the big Western headquartered companies are massively operating in emerging markets. And so the same standards, if they were applied to developed markets companies, because they've got factories and they sell and they build and they source in these countries, if they were held to account, it would have a ripple effect into emerging market economies, and they would be more sustainable in terms of how they develop. And this is one of those things, again, where I think there's a lot of good development of technologies, of practices. This can happen today. And, again, I've been a person who's not dealt in the government in my life. I've dealt with companies and investors, and I cannot tell you, never underestimate how sensitive to creating shareholder value boards are. And if boards believe that they will be rewarded in the stock market for behavior, they will make management do it. And if they set out a scorecard for management, most management teams, you get to the top of these companies, they're really good at executing. It can happen fast, and it can make a profound difference. And I just want to make sure in our discussions we don't overlook the power which the investors have to make this change.
That's really interesting. That's great, Jeff. And leads me into our next question, which is really about investor education. But I maybe want to turn this around a little bit, since you talked about really getting this into the boardrooms and into companies and raising the awareness thing among corporations and companies. Chris, what are the challenges for doing this inside financial institutions and investors? Are they the same? Are they different? What do you see happening on that front?
So actually, I would like to continue where you're leaving a little bit, and I fully agree with you. There's an extreme cynicism around, and that's because we have very strict mandates. We're inflexible in respect to our mandates. And that means that there's the need for education. There's the need for raising awareness. I will give a couple of examples of what we have seen. So we've been, as I mentioned, the market of green bonds have 370 billion. We've been advising issuers representing roughly 20% of that market, meaning roughly 70 billion, 75 billion. What happens when we do green bonds, that is that we learn. We're working together with engineers, we're working together with the water authorities in Holland, which are the best water engineers in the world. They teach us, they teach our investors. We're working together with the World Bank, with the IDB. We have not worked with you yet, but we're working with the World Bank, the ADB, the AFDB, the IFC, and EDC, and KEXIM, and all those and their frameworks, and we are learning what they're doing. And what we're learning is actually extremely pragmatism. It's about how people behave. It's about behavior. And when you look at that, we've been financing projects like replacing fridges in Mexico. The World Bank used the money raised by green bonds to replace fridges in Mexico. And the way they did that was that they went out to a lot of households and basically realized that these households had old fridges which consumed a lot of energy. And by replacing the fridges, they could save so much energy, so the replacement was not only for free, but it was actually sufficient to pay a couple of dollars to the family that made the replacement every month. So it was not only reducing pollution, it was giving money to the people. And they took the old fridges away and put them into recycling. Examples like that, examples like public transit in Bogota or Mexico City with bus rapid transits, reducing time, more time efficient, reducing costs, and saving the environment, exist all over. It's a matter of getting it out. It's a matter of sharing experiences. It's a matter of building a global library. It's a matter of actually being able to compare environmental and economic impacts of these projects. And that is doable. There's a lot of experience. There's a lot of experience with the industries, and there's a lot of opportunities. So going back to the boardrooms, going back to the shareholder value, going back to education, if there's a lot of opportunities out there, and they're not being done, it's about creating financial systems that's actually supporting that kind of export. If I can go to my industries, we're 16,000 people with a leading corporate bank in the Nordics. If we can go out to our corporates and say, we can help you to sell more products, they're going to listen. And if those more products are leading to recycling of old, inefficient products and creating better systems, we're going to get a sustainable growth rather than a destructing growth. And at the end of the day, that is what we need and that's what we want. We want to build societies, not destroy the societies. So building bridges, education, sharing experience, I think is the road.
Interesting, and we'll come back to kind of the how you might do that in terms of getting from experience to experience to experience to scale in a minute. But maybe I'll turn to you, Maria, and just get your views on the landscape from within IDB and also in the region that you're seeing. This conversation around investor education and building experience from the inside, learning from that. How has that impacted what you're doing at IDB? And then maybe do you see opportunities in Latin America across various asset classes that you could take those learnings to?
Thank you. Well, opportunities in Latin America as an emerging economies obviously are huge, and our mandate is to cover all the region, all the countries within Latin America, but we do it in different ways. Now, if we're talking about how to bring private sector, or how to mobilize private sector capital to the green agenda of the governments, right now we recently signed a partnership with the UK government for a 230 million program to come up with different, combining different instruments to mobilize more capital, private capital, to contribute the acceleration of the implementation of the national determined contributions of 4 countries in the region. So right now, we really are focusing some efforts looking for catalyzing financing through capital markets in Mexico, Brazil, Colombia, Peru, and Brazil, Mexico, Colombia, and Peru. And the idea right now is it's not only invest in clean energy or low carbon projects, but actually to start introducing the concept to investors of sustainable infrastructure. And again, for us, sustainable infrastructure is not only ESG compliance. For us, sustainable infrastructure goes more beyond that, and it comes from working with the governments in the design, in the pipeline of projects, in the procurement process of hiring a contractor, on finding the best financial instrument, working with investors to help them with not only financial instruments, but also tools to assess the risk that they are having in their portfolios. And this is not for them to invest, but actually to start increasing their investments in those infrastructure projects that include economic sustainability, environment sustainability, social sustainability, and finance sustainability. So it's an education process. I was recently invited to another conference last week here in New York regarding infrastructure. And again, talking with investors was, okay, yes, I have my ESG department. And again, it's our duty to help investors, because we typically work with governments and with issuers, but we need to spend more time with investors to get them clear with the concepts and to help them with different tools for them to assess an investment.
Great. Maybe I'll ask a question of all the panelists and you can all kind of respond, but how do you get from where you're observing some of these challenges, whether it's that, you know, these sustainability questions are in the ESG group, reporting to investor relations, not in the boardroom, the learning that needs to happen through the issuance of a green bond, which takes time, right, to feed back into the system, or some of the essentially demands for sustainable infrastructure you're seeing on the ground. How do you get from there to scale? The Clean Trillion, you know, campaign and what Ceres is articulating is that there's $5.3 trillion of investment need in clean energy alone right now needed annually. And how do you get from the kind of practical lessons on the front line to that type of volume, and how do you get there fast? You want to take a shot at that?
Yeah, I think I'm the mainstream banker in this context. So I think it's about simplicity. So for doing that, you can't look at the projects. You need to look at the investment mandates. You need to look at how the monies are being deployed. And most investors have streamlined the organizations, meaning that their mandates are very linear, they're very straightforward. And you basically need to convert or aggregate, I think you used, which was a very, very good work. You need to aggregate the projects and convert them into a vehicle which fits the investment mandates. I think it would be naive to believe that you can, in a fast version, convert the mandates from the investors. It's very built, robust systems that have been built over time. Along that, there's of course the need to educate investors and make them feel comfortable in respect to governance and the way that the projects are being aggregated. But I think that's a part of the process, and I think that products like green bonds, which are enabling to engage mainstream portfolios in a mission inside existing financial mandates, is a way of transferring the comfort and the experience from the MDBs and others into the investors, and thereby build the bridges which are required. And that's also what we are trying to do when we're trying to merge the microfinance with green bonds.
Well, again, I'll just to kind of go to the equity side. Imagine being an equity investor where every company reports its own accounting convention. Some companies have depreciation, some companies don't. You know, some companies have OpEx as part of cost of goods. It'd be impossible. That's what's happening right now in sustainability, and the companies like it that way. And I'm saying right now, what I think investors should do is coalesce around. There's 7 industries out of 76 that SASB has kind of developed harmonized standards with. And SASB is like FASB. It's a really accounting-centric, really very knowledgeable group that's been funded by a number of foundations, including the Bloomberg Foundation, to develop real standards. They've got it, it works, and everybody agrees with it. But that you should say to companies, we want you to report these metrics this year, 2018. It can be done. It can be done on their 10K or a sustainability report, so that investors will have one set of standards to be able to look at companies. And that's the first step in companies paying attention to what they're really doing, because right now they can't. And it's like one of my favorite bands is The Who. You know, I think investors have to wake up and say, we won't be fooled again. And it really is, all this other stuff, it's all just, they'd love to say we're going to study the UN SDGs, which I think are very admirable, but, you know, number one is, you know, end poverty. Well, if we destroy the planet, we're never going to end poverty. So it'll take a while for these other things to kind of evolve, and I'm all for it. But right now, today, in 2018, companies can start reporting their carbon and their water use, and there's only 7 industries that are 85% of the carbon, and let's get those 7 industries to report it. And my knowledge of companies and how they behave is that the Chief Sustainability Officer will report to the CFO and to the Finance and Risk Committee of the Board, and they will take action. And that will kick off a virtuous cycle.
And for us to scale, the needs are basically, first of all, make it easy, as Christopher already mentioned, easy frameworks on establishing green bonds framework, sustainable infrastructure frameworks, easy to understand, and maintain a dialogue between public and public and private. It can be, again, it's successful to do a public and private partnership, but we need to create a framework, so we need to create an easy framework, not complicated, so again, but we need to keep the dialogue between private and public, because public can go and do policy, but are not taking into account what the investors are looking also for, and the other way around. Policymakers may say, well, this is good, and then again, there's a disconnection between the two sides. So we want to maintain in every dialogue of new instruments and new frameworks, we want to maintain both the dialogue between the private and the public.
Maybe I can just add in this context. So we have been very active on a global scale, and one of the things which we have actually seen, looking from the public sector, which have been working, that is in France, where they have introduced a paragraph called 173. So they basically ask investors and issuers to report on their impact, and by doing that, you're forcing people to have a view. When I look back through my history or my career, I've seen it once before. I saw it with pension liabilities. So many years ago, people didn't look at pension liabilities. Today, it's a part of reporting. It's a part of the wealth of a company or lacking wealth of a company, whatever. And to allow or to force people to actually have a thinking about that and allow the general public and also investors to get an idea about their exposure and the potential liabilities inside this field is going to create a common definition and common road. So I think that we are already beginning to see the measurement of the potential liabilities inside balance sheets, and I think coming from the public sector, I think that's a way where they, without putting too much stress on the system here now, can actually enforce a very, very rapid change in behavior. And we have seen that in France. The French investors are pushing issuers, and the French investors are pushing issuers not only in France but across the globe to actually engage.
If I may just add just one quick thing there, that's a really great corollary relative to pension liabilities. And listen, our hope is to make ourselves obsolete in a decade. That green bonds, it's all done that way. You know, the stuff that it's everybody, that every company, you think about, you know, environment, you think about the sustainability when you make an investment, when you make a capital allocation decision. And so that's like pension liabilities. Nobody even, you know, it's just kind of part of the fabric today.
So we've got a few minutes to open it up for questions. If you have a question, please raise your hand and then use your microphone. Push the button to turn it on. It will turn red. So, did I see a question over here? Go ahead. Under the microphone.
I wanted to ask a question that ties to the Sustainable Development Goals, which came up earlier, as well as the Paris Agreement, and sort of the implicit understanding that no one would be left behind as we move towards sustainable energy for the entire global population. I'm particularly interested for Stacy and a couple of the other speakers about sub-Saharan Africa and where there are, you know, fast-growing economies. There's a lot of growth in solar pay-as-you-go companies. There's a lot of grid renewable opportunities and a big, huge interest in electrification in general because big populations don't have electricity. I was curious for some of the green bond experts as well as Stacy, where do you see opportunities in Africa, whether it's in infrastructure, electricity access, grid, off-grid? Would be interested to hear more on that.
Great. Maybe we'll take a couple of questions and then come back. Anyone? Any other hands in the room? Don't be shy. Okay. Maybe I'll turn to you guys for the green bonds question, and if you had any insights into emerging markets and even in your work in fund, Jeff.
I would just say that's a big issue. There's a group called the Terawatt Initiative. Have you met with them? Yeah, they're actually in our offices tomorrow, and I want to I'm going to introduce them to you too, because they're really looking for exactly finance mechanisms and policy to basically create a consistent set of PPA contracts, and that you can aggregate to have kind of a very efficient way of financing distributed renewables in sub-Saharan Africa. So I can follow up with you after.
When you're going into Africa, it's a challenge, right? It's a huge area, and the population is growing very, very rapidly. So it's going to be a huge market. I mean, we've seen Asia growing very rapidly over the last couple of decades, and we're going to see Africa grow rapidly over the next couple of decades. And that means that there's going to be all the same possibilities and opportunities that you're seeing in Asia with new technologies. We have heard things from Bloomberg today that you might not need grid. I think that might be a little too early. I think we will still need grid. There's a lot of energy in respect to solar and even hydro places in Africa. There's also a lot of challenges in respect to drought and urbanization. So you have all of it. And in my world, the challenges are not in respect to where to focus, but that is in respect to how to secure governance. So one of the biggest challenges you will have out of the US or Europe, that is to feel comfortable that they actually have some kind of governance around the money you're doing. What we have been doing historically, in this context, that is that we've been going together with partners who know how to deal with governance in those regions. So when you go in Latin America, you go with the IDB or you go with the Central American Development Bank in the beginning, just to learn how they look at things. And as more comfort you feel, as more you learn from them, as further you can go on the risk scale. And my guess is that when you go on the risk scale, you then look at the most developed markets. You have a number of countries inside Africa which are having quite good systems. And you're having a number of systems which are being built right now. So in my world, the first areas will be energy and it will be housing. And then the third area would be exports, like you've seen in Asia. So what kind of export areas do we have down there, and how can it be governed? So that's basically the way I would be looking at it. In respect to the governance, in respect to the safety, I think that green bonds can be used as an item. So what we are seeing that is that if we're going into the US, most investors will like dollar products, right? You see USD issuance if you want to go in. And to work in collaboration with the development banks like AFDB on B loans is going into a new risk class. And you can do that. Normally you can do that in hard currencies like dollars. So this is the kind of approach we're looking at. For us, Africa is early, so we're not really looking into Africa at this stage. We're still trying to get our thoughts around Asia. So we're still in China, we're moving into India, we're looking towards Africa. And what we do in Africa, because we do things we do together with the MDBs to feel safe that we know what we're doing.
And maybe I'll just say a note or two, and essentially, energy access, of course, is a significant challenge all over the world and in Africa, as you know. The off-grid and distributed generation and microgrid space, of course, is a different business model than most energy investments anywhere else in the world. I would hazard to guess that our panelists up here are probably operating in a financial space that's much different. Ticket sizes of MDBs are, pretty large compared to what your individual microgrid might need, or even an aggregated investment of microgrids in sub-Saharan Africa might need. So you really, from my perspective, there is a gap in the ecosystem between kind of the international sources of finance and what actually exists on the ground. And there are some funds and some investors that are really targeted at this space, but probably looking themselves at things that are already aggregated. So how do you fill in that ecosystem all the way down to the microgrid or set of microgrids in a country or a region that really needs, from a ticket size perspective, a much different level of investment, but also has to be assessed on a different set of parameters. Most microgrid business models are not cost per kilowatt business models. They're white goods, they're services, it's different, it's consumer services. So we can have another discussion about ecosystems and where there's some gaps at the local level, but this is a perfect space for it. Sorry, did you want to say something?
Yeah, maybe I can just come in with an additional one. So I mentioned that we have a very, very large microfinance fund. One of the nature of a microfinance fund is it's global. So it's not only Africa, it's also Latin America and Asia, meaning that it has diversity and is having a balance in respect to volatility in currency baskets. And that's, of course, another way to go in. I think what I talked about before, where we're merging the microfinance and green bonds to source capital, labor capital, and microfinance to source projects and audit projects, is what you will need to see. You need to see some aggregation models which are enabling you to assess the governance model in a shell, and then transformation mechanisms which are allowing it into your investment universe, whatever that being, BBB or single A or whatever you could talk about, yeah.
Well, and the last point I'll make is just equity and debt and products are really important. I mean, they're not going to be necessarily the same. So we had another question in the middle there.
And one more over there.
Hello. Yes, I want to sort of drill down a little bit into your metaphor of ecosystems and international financing institutions. What role, if any, do you envision the Green Climate Fund to play at this point in history in identifying and addressing those gaps in the ecosystems and in mobilizing a private sector investment?
We are a credit entity for the Green Climate Fund. It's hard to get a project approved by the Green Climate Fund. We understand that, but it's getting harder not because of the things you need to report at a project level. It's hard because you compete with tons of projects, and at the bank we have already approved 5 projects. And we are going to approve this year 2 more, and we have 20 in pipeline. And it's easier for us to say that we have found a way, but again, we reject a lot of projects that come to us to say, let's do it with the Green Climate Fund, because we understand that the Green Climate Funds, they're looking actually for those projects that use innovative mechanisms and that are that bring scale and replicability. So to bring, just as an example, a solar distributed generation project to the GCF is not enough because it's green or because you aggregate. No. There's already a market out there, and India has a lot of solar securitization. You really need to think out of the box to bring a project to the GCF because again, there's tons of projects, and it's difficult to compete between projects. So the level of additionality, the level of leverage you bring on mobilizing private capital gets a lot of points for the GCF committee. So if you bring capital markets or private equity or a private investor, and you leverage actually the funds of the GCF, then you have more chances to get your project approved.
I would just add very, very fast. I think that the biggest success of the Green Climate Fund, because I think it is successful, I would agree that it's a bureaucracy and it's very, very difficult to get access to money. But the biggest success is that it has actually mobilized and harmonized the dialogue with agencies across the world in developed countries. So because of the commitment of 100 billion a year, governments, Minister of Finances, which were suddenly finding themselves obliged or liable to pay into the fund, try to identify what they already did to avoid paying. And thereby they started consolidation of information and activation of infrastructure, which had harmonized and created interaction between agencies across the world, meaning that there's a much more focused dialogue now than there used to be.
And maybe I'll just add,
There's one question there.
but we're out of time. We're out of time, unfortunately. 1 minute left. I'm getting my little notes here. But on your comment about GCF actually is a really important one, and is a long discussion about the role and function it can play in helping to catalyze these things. And we could talk at the break over here, as I'm being told. So anyway, I want to thank our panelists. Can we give a round of applause for our panelists? Thank you very much.